What is behavioral finance, you're probably asking yourself? Sit back and enjoy this short explanation on everything you need to know. Behavioral finance is the combination of the fields of economics, finance, and psychology to try to explain why people make irrational financial decisions. In theory, markets are efficient. However, in real life, real people make decisions that lead to inefficiency. Behavioral finance tries to explain why and how this happens. In the social sciences, there is something called the herd effect, which also affects financial markets. The tendency people have to do what other people are doing. It means that individuals will invest in a specific stock based solely on the fact that many other people are investing on that stock. If you ever heard of a FOMO, you know what I'm talking about. The problem with the herd effect is that it causes bubbles and subsequent crashes based on nothing else than the way people behave. Sometimes, even if nothing in the company's fundamentals have changed, their stock prices may skyrocket or substantially decline based on nothing more than the people's sentiments towards that stock. For example, if McDonald's is facing a lawsuit because they served their coffee too hot and someone got burned, their stock prices might go down. Then, if McDonald's faces another similar lawsuit, investors, knowing the stock prices will go down, will start to sell their shares, further declining the stock price. Now, investors in other coffee companies such as Starbucks or Dunkin' Donuts, knowing McDonald's faces such type of lawsuit, may start selling their shares for fear of loss. And the whole industry suffers, even though Starbucks and Dunkin' Donuts had nothing to do with it. So, you can understand why behavioral finance is important. It attempts to explain price movements in the absence of any other logical or theoretical explanation, especially when nothing changed on the part of companies or sectors. As many things in life, financial markets are cyclical, meaning that after a bull phase, there will most probably be a bear phase. You've probably heard about a bull or a bear market. It means that a market has an upward trend, like a bull's horn, or a downward trend, like a bear attacking. Bubbles and crashes are recurring events in the financial market as well. Bubbles appear when there is an expectation about an event, and that leads to a rise in prices. Except at a given point, people don't want to pay such a high price for stocks or assets anymore, and the bubble bursts. For example, in the late 90s, the internet was the fastest rising industry, although most companies did not have financially sound business models. Investors, thinking that because they used the internet frequently, they had an understanding of that asset, started buying stocks frantically. Priceline.com, a travel agency selling airline tickets below their purchasing price, saw their share price rise from $16 to $85 in one day. Eventually, the market crashed as prices got too high and people didn't want to invest anymore. See, what happens is investors have an unfounded overconfidence in the market because they feel reassured when they see people doing the same things. That is called the herd effect. They also think that they know the asset more than others, which would make it less risky for them to invest. That is called the familiarity bias. There's one last thing you need to know. What is policy uncertainty? Economic policy is when the government intervenes in the economy with systems for setting taxes, government budgets, money supply, interest rates, etc. Uncertainty arises when people are uncertain, about a country's government and therefore delay spending and investing in a particular geographic area or industry. This refers to uncertainty about monetary or fiscal policies, regulatory regime, or skepticism over electoral outcomes. Hi Trump! A new index was created in 2012 in order to measure the level of economic uncertainty in news-based sources and how often it occurred. Called EPU, it helps understand the relationship between economic policy uncertainty and fluctuations in output, investment, employment rates, etc. Check out this graph. We can clearly see that major events, such as elections, make uncertainty increase. We hope by now you understood a bit better what behavioral finance is and the importance to study it. Thanks for watching!